Our next guest is no stranger to what's happening in the world or to our radio show for that matter. We've had a chance to hang around Daniell DiMartino Booth in person back when we could all do that. And she's been a very provocative guest on the show. She has a background in banking. She writes an amazing newsletter we'll talk about before we're done. And she has some key insights, especially when it comes to central banks, monetary policy, and we'll even talk real estate today. Let's say hello to Daniell DiMartino Booth. How are you?
I'm doing great. How are you guys doing?
We are good. We see you're everywhere, so you must be busy in the midst of lockdown.
I am very busy. I can still count on two hands the number of times I've actually left my house, but I've set up my busyness here at home.
Yeah, which is a big shift, of course. Now, I'm knowing a lot of our listeners have read your amazing book, Fed Up, Why the Federal Reserve is Bad for America, but some folks haven't. And maybe we just start there, Danielle, since you're someone who is clearly an insider, working with the Federal Reserve for 9 years in Dallas, and then coming out with this opinion that the Fed is maybe not what we need. Give us the quick tour on that.
So the thumbnail is that at the height of the last crisis, as opposed to the crisis we're in right now, the Federal Reserve realized that it had the wrong inflation metric. It hadn't picked up on real estate inflation. It hadn't picked up on asset price inflation in the stock market, the bond market. So there was a realization inside the Fed that they needed a new mousetrap, and then they decided to do absolutely nothing about it. And that got me really angry. And I stayed angry. And when I left the Fed, I wrote Fed Up. And here we are, however many years, 12 years later, and we still have the Fed using the same exact broken inflation metric and monkeying with markets and destroying price discovery across, you name the asset class. So I'm still I'm more fed up than I've ever been.
Well, and right now, of course, what we're seeing is unprecedented stimulus, printing like crazy. We've been anxious to get your view on that because a lot of folks are weighing in on it, but you maybe have a unique perspective there. This is the one tool the Fed has, right? Just stimulus. And how's that working out?
Well, it's interesting that two of the areas that the Fed is the most needed right now are municipal bonds and commercial real estate. And these are the things that the Fed decided they would never step into in the last cycle, along with corporate bonds. And these three sacred cows have effectively been thrown out the window. So the Fed has done some Enron-esque type of off-balance sheet accounting. It has set up special purpose vehicles at the Treasury because it would violate the Federal Reserve Act of 1913 if it owned any of these securities outright. So it has basically found a workaround around the law. If you were a lawyer, you'd say that the Fed got off on a technicality and found a way to delve into these markets that were definitely the most risky going into this crisis. We knew that corporate credit was an accident waiting to happen. We knew that commercial mortgages, commercial real estate was way overvalued. We knew all of these things going in, and sure enough, the Fed has had to come in and rescue them, plus Illinois.
Right, and the list is likely to go on. I mean,
Oh, yeah.
We were talking with Adam and Chris earlier from Peak Prosperity about, oil and the defaults that are happening because of low oil prices, and likely we'll see the Fed, step in there.
I'll push back there because I think that the Fed has drawn a line in the sand, so they won't take on truly insolvent companies that are headed for default. And what you're seeing, especially with the larger oil companies, Chevron announced, I think, 6,000 layoffs. So once you see the larger companies come out and announce these layoffs, you see Dallas Federal Reserve President Robert Kaplan said that he expects 30 to 40% of insolvencies in the energy patch. Once you see this happen, you'll see consolidation in the industry, but it's going to be messy for a very long time. If you look at any of the states in the oil patch, their unemployment rates are higher than states that are not as affected by what's going on with crashing oil prices.
And Danielle, I know one of the things you've been talking about is that while we have seen this abrupt change to employment in the last few weeks, really, it's not going to heal that quickly. Talk about that process.
So, there's one of the reasons I think that the stock market is as buoyant as it is because there's this assumption that you're going to have this massive reopening, V-shaped recovery. if you're talking about Boeing aircraft, if you're talking about Amtrak, if you're talking about the Google hiring freeze, there are a lot of companies that are pushing through permanent layoffs, and the Paycheck Protection Program, the commitment that companies have to keep these people on the payroll, that expires at the end of June. So you're going to see another wave of layoffs begin to build among companies that don't have the end demand that they need to keep their original headcount with them. And you're going to have a separate wave of companies that are coming off the Paycheck Protection Program, and they're saying there's still not enough, so that they're going to lay those people off as well. It doesn't feel as bad as it could because so many people are collecting an extra $600 a week. So we have de facto universal basic income going on if you're Joe Schmo collecting an extra $2,400 a month from the federal government.
Well, and we'll come back, talk a little more big picture, but I know specifically your mind's on real estate right now, and we'd love to hear what your take is there, especially since this is something you watch. You watch a lot of things in a lot of maybe untraditional ways, but let's talk about real estate. Obviously, this is going to have an effect. If I'm unemployed, I can't pay my rent. If I don't have a business, I can't pay my rent or buy an office building. What are you seeing in real estate?
Well, what we're seeing in real estate right now is there are three major trends going on. You've got a lot of small mom and pop investors who have discovered that they've got one too many mortgages. 19.3 million single family homes are owned by about 15, 16 million small investors. A lot of them bought in 2012, 2013. They've made some great gains on these homes. And they're, again, realizing that, you know what, I don't want to be in the Airbnb business anymore. This is more than what I signed on for. They're not exactly in the forbearance game. They're not getting these grace periods. So you've got pent-up supply coming from this one cohort. You've also got an additional 20 million homes of pent-up supply with what we call the silver tsunami. Zillow has done some good research on this. It was expected that these homes would come out in an organized fashion, little waves after another as boomers join the retirement pool. That's not what we're going to see. We have not seen a rebound in higher income earning or older Americans that we've seen among those who are getting this extra $600 a month. Your lowest income earners right now, who are basically on a form of welfare, are the happiest. They're registering the highest amount of consumer confidence. You're not seeing that they're paying their rent, they're paying their car bills. This is kind of a mirror image of what we had with the subprime crisis, because right now the people who have the lowest housing costs are able to carry them. And then you've got the boomers and the investors, many millions and millions of whom are going to want to list their homes to sell as soon as they feel safe doing so, or they can do so with reopening, especially in the case of a state like California, where you've been told that you cannot evict your tenant, and you can't evict, you can't collect their rent. You just, for a lot of investors, the math is going to stop working. So that's one dynamic. The other is that there is going to be a surge of movement into the suburbs. The question is going to be at what price. So we're seeing pending home sales in the major metropolitan areas. Redfin has 7-day data out. Redfin's website's down right now, very curiously, and it's been down for a few days. But through May 15th, San Francisco pending home sales, 7-day moving average down 60%. Similar things that we're seeing in Atlanta, Dallas down 55%. And that's on top of what we know is the national 22% decline we saw in pending home sales in the month of April. So you're going to see a lot of pressure in the major metropolitan areas, the densely populated areas that I think a lot of people are going to want to get out of. But again, you've got this pent-up supply that's going to be coming onto the market. And on a positive note, I would say that you are going to see millennials and baby boomers looking for new homes at entry price levels. So if you can profitably build those, maybe a D.R. Horton, then you're going to have a very, very sweet spot, because affordability is going to be such a problem going forward.
Well, and of course, a big component of affordability is going to be financing and interest rates. Interest rates are low, remain low.
Mhm.
Kind of the word is we expect that to be for some time. What are your thoughts on interest rates over the midterm, maybe?
I don't think the Federal Reserve is going to raise interest rates anytime soon. Jay Powell is being very forthright and saying, that this could be the lowest forever, that, we had lower for longer and then we had lower for even longer than that. And they're saying, again, for the foreseeable future, they don't see inflation as being problematic. And I think that that is indeed going to be the case. There are a lot of deflationary forces at work in the economy. Unfortunately, combating that is things like food inflation being up 4.1% year over year. So you're really starting to squeeze households in that way. Low mortgage rates are going to be a tailwind for sure. But again, in a lot of these metropolitan areas, you're talking about jumbo mortgages, and that is the market right now that is doing a lot of nothing. And the spread between the 10-year and the jumbo mortgage rate has not come in. Again, if you're talking about boomers selling McMansions, investors selling high-end properties, there's going to be a lot of tension there between the selling price and what sellers think they should get and what buyers think they should get.
Well, and if there are real estate professionals listening, hopefully they'll pay attention to that, because I know in my neighborhood, the local realtors think everything's rocking, but we see it the way you do. Let's transition for a minute over to commercial real estate, because that obviously is going to have an effect based on businesses changing, unemployment and all that. It tends to be more stable, longer term tendencies, but where do you see the ripples in the commercial real estate side?
So, as was the case with the corporate bond market, that was an accident waiting to happen. Retail was an ongoing accident that has now been expedited. So we've already seen, for example, the same number of store closures through May that we saw in all of 2019. And we said that can't get any worse. It is. So your strip centers, your malls, they're going to be under, and you see that reflected in the REITs that specialize in malls. What you're not seeing is, I think, reality reflected yet in the office space. There are a lot of big companies right now that are saying, we're doing just fine productivity-wise with this telecommuting. We're able to identify our best workers who are most efficient under really extreme circumstances of schooling their kids. Twitter said it. They're going to have forever telecommuting. You don't ever have to come back into an office if you don't want. Google, Apple, they've said you can stay working at home to the end of the year. I think a lot of companies, if they're going to be cost constrained in the years to come, if we don't have this V-shaped recovery, they're going to take a second look at what that overhead is attached to housing their employees and look to maximize the efficiency by reducing the amount of office space that they need. So I think that that's something that you should also bear in mind. And then there's obviously hotel lodging. That aspect of CRE is a train wreck. And we've had massive overbuilding in the lodging space over the past decade that's exacerbating that situation. And then finally, you've got multifamily. And so much of multifamily was built in the densely populated downtown areas that they're saying even millennials are going to be leaving for the suburbs. So 82% CoStar, I think, said were luxury developments in these big high rises that we've seen pop up all over the country. Let's see what happens with those super high-end rentals and what, the value that those multifamily properties retain going over the next 2-3 years. It'll be interesting to see.
Boy, it sure will be. This is one of the, age-old dilemmas of development. It takes so long to get something like that out of the ground. So you do your research, you see there's demand. Okay, here's an area we want to be in. Everyone's moving downtown. There's a new college campus. There's a new mall. And now something like this black swan comes along and people are like, I don't know that I want to be in such a crowd. So it's definitely interesting to watch. One of the things we want to talk to you about, Danielle, is just kind of bigger picture with your background on the credit markets in general. There's real estate loans, and our listeners are very familiar with that whole process, but there's more to it than that. And just the banking and the credit markets, and with QE continuing forever, with the change in people's behavior, fewer people probably walk into a bank lobby than ever have in the past. What do you see there on the horizon for banking, for credit markets?
So I think we all know that mobility is going to be big in all forms. we're going to get used to having doctors come to us, and we're going to, even us old stogies are going to figure out how to do mobile banking on our phone, especially because 53% of Americans are very concerned about the coronavirus still, according to the latest weekly data. So I think a lot of people are going to learn to do a lot more with less. Dodd-Frank imposed, and the Federal Reserve kind of compounded small and mid-sized banks' regulatory compliance costs in recent years. Congress backed off of that about a year ago, but in the run-up to that, you had a lot of riskier construction loans and development loans that were made at small and mid-sized banks than they otherwise would have, so that they could try and get enough yield, get enough pickup in order to offset this compliance cost. That tension's gone, the loans remain. So it will be interesting to see what happens with small and mid-sized lenders after these forbearance periods go away. We're hearing from bank officers that the bulk of the forbearance that they're being asked for is not necessarily on the residential side, even though you've got 9% of homes with a mortgage right now in forbearance, but they're seeing it on the commercial real estate side. So the grace won't last forever. So I think we're going to have stress in especially the small and mid-sized lenders. I don't think that the biggest banks stepped as knee deep into it this time as they did in the last cycle.
For me, Danielle, I think the thing that I've been looking at as I've tried to go through the food chain of what happens, health crisis becomes an economic crisis, all cash flow stops, including debt payments. That translates into a financial crisis where bond markets collapse, banks have all kinds of pressure on them. Even all the way back before COVID-19, we were talking about what was going on in the repo market. And I'd love to hear your thoughts on that. But then ultimately, to try to stop this, it seems like the Fed, and you know much better than me, is not reacting in denial like they did in 2009, where Bernanke came out and said, hey, it's contained. But they jumped way in front of it and whipped out the printing press. And then the government got involved and whipped out the checkbook and said, we're going to spend, we're going to print, we're going to paper over this thing. And so to me, it seems like all of the pressure lands on the dollar. So I'd love to hear your comments on the repo market, but I'd really love to hear, is the dollar strong enough to prop up worldwide debt markets that are going to implode as a result of this economic crisis and payments cessation?
The dollar is a trickier issue. The repo situation, the crisis that we have right now in the financial system started in mid-September 2019. People need to realize that. The amount of liquidity that the Fed was pumping into the system at the end of 2019 was the highest level since 1969, highest level on record ever. And they called it not QE, but there was a serious reserve issue in the system. There simply were not enough reserves. Currency in circulation had increased globally. Foreign central banks that had imposed negative interest rates, they were parking money at the Federal Reserve. That was pulling more reserves out of the system. Currency in circulation pulls reserves out of the system. And the Fed was doing quantitative tightening. It was pulling more reserves out of the system. And they were raising interest rates at the same time. So it was this massive form of tightening that we clearly saw the banking system, the financial system could not handle. So the Fed had to come in with not QE, buy out to 12 months in order to pump reserves into the system. Repo has disappeared overnight as a problem, because what repo really needed was for the Fed to come out and just do full-blown QE, which they did. So the repo issue disappeared in the blink of an eye, the minute the Fed came out with massive amounts of quantitative easing that pushed the balance sheet from $4 to $7 trillion and counting. So that situation went away, but you need to understand that that's where this all started. As far as the dollar is concerned, it's very tricky. The European Central Bank, the People's Bank of China, Japan, they're all pushing a lot of stimulus out into their economies. But especially in the case of Europe, their banking system was not as strong as it needed to be going into this. They've still got a ton of bad loans that they never worked through from the last crisis. And the same can be said of Chinese banks. And 80 countries have gone to the IMF for funding, 80. 8 emerging markets. I mean, you've never seen numbers like this. This is unheard of as the crisis moves into Mexico and all the way through South America, as South America has this COVID crisis clashing with winter coming in the Southern Hemisphere. So for the moment, there's so much else going on in the world that even though the Fed is trying really hard to kill the dollar, and so is Uncle Sam, and we're putting on more debt than you could ever imagine and running de facto universal basic income, and we're blowing out to $30 trillion of debt by the end of this year, probably as a nation, the rest of the world is still in such worse shape that the dollar's still got some resilience. It is an election year, and if there's not a V-shaped recovery, if there is a permanence in the layoff situation, if unemployment remains uncomfortably high, there's a good chance that Trump will do something with regards to China. And the only thing I think that could unseat the dollar would be something that erupted in that arena. And that has nothing to do with the financial and banking system, but it would be grounded in economic distress.
So speaking of China, this is the other thing that I've been watching this since 2013, I think, is when I first started really paying attention to it. But China has wanted to de-dollarize for a long time. China's famous for ripping off, if you will, or copying other people's ideas. It seems to me like they kind of looked at what the United States did to end up as the world's reserve currency, and they've been systematically doing that, expanding their bond market, putting the Asia Infrastructure Bank, the Shanghai Gold Exchange, all those different things. And I pay attention to the gold community. And one of the things that I noticed was over the last couple of years, central bankers, who are the ultimate insiders when it comes to currency, have been stocking up on gold. So it makes me wonder, what do they know? And I asked Peter Schiff this question, but, and of course he's a big gold guy. The thing is, if China or somebody, but let's just say China, were to come out and say, hey, world, we have a lot more gold because all of our people's gold is our gold. We've got 10,000, 20,000 tons of gold. We're willing to come up with a partially backed or fully backed convertible yuan. We got a great economy, pretty strong balance sheet, and a big, deep bond market. I mean, is it possible that if we end up in an altercation with China, China's nuclear bomb isn't one that explodes, but it's one that implodes the dollar? Could they pull that off? Is that something investors should be thinking about?
I don't think that this happens without the altercation. I think what you've described is that they're preparing for it. And that should be the scarier of the two possibilities. So they have, excuse my French, they've pissed off so much of the world with this crisis. And you had 116 countries join Australia in demanding an independent inquiry into the origin of the virus. With the World Health Organization. So they're not in a position of strength right now when it comes to their, even their potential allies. Australia's 7.4% of Australia's exports go straight into China, and they were in the lead asking for this inquiry. But I think that they're financially prepared, if you will, to find a way to unseat the dollar's reserve currency status in the event of an altercation. I don't think that they've got the power right now to do it on a pure economic basis, because they're dealing with their own bank insolvency issue right now, especially in the rural areas of China. And they say that, I've got friends who study the Chinese economy, and the estimates right now are that especially outside of the major cities, you've got 20% unemployment running. So they need to, the possibility for social unrest on the mainland, and obviously with what's happening in Hong Kong, suggests to you that China's not in the best position of strength right now. But again, we are in an election year and anything can happen, and there's a lot of saber rattling going on. And I think that if we were to cross that red line, that China is prepared to try and use it as an opportunity.
So what about gold on the macro level, right? Central banks accumulating it. I don't understand, why, but it kind of feels like when the repo market was imploding, I remember talking to Robert, like, there's a lot of smoke coming out from under the hood. I don't know what's going on, but something's going on. And then now I see the central banks accumulating more gold than they had since 71, when, the dollar collapsed after the default on gold under Nixon. It's like, okay, something's going on. And so it just makes me wonder, is there a role for gold at the macro level, whether or not China acts on it? And then the question is, at the micro level, is there a role for gold in an investor's portfolio based on what's going on, in your opinion?
Well, we have to remember that gold is a hedge against deflation and inflation. If you look back historically, it has outperformed in times of distress. And I would say that we're in a time of distress. So if you don't own gold, you sure as hell should, because it's a perfect hedge for the unexpected. And we're in an era right now of the unexpected happening. On a macro level, if you ask any traditional central banker, Keynesian type of economist, how we're going to extricate ourselves from this debt mess, because everybody keeps building it up. As of Q1, right, we had $325 trillion of debt worldwide. Their stock answer is a debt jubilee. Now, if you don't believe that a debt jubilee is going to be feasible and that we're going to come together as a world, including China, and agree to expunge all sovereign debts and just start clean, if you don't believe that that's going to be feasible, then you're going to want to have a war chest built up just in case. And I think that what you're seeing is a reflection of growing global anxiety about the role that the dollar plays, because at some point there's either a very allied driven debt jubilee or something else.
That's awesome. So
That's
happy
right.
that we had a chance to talk with you.
All right, great stuff. I knew you wouldn't let us down. We're going to hear more from Danielle in our lightning round, but thanks so much for being with us today and for all the amazing work you do.
Thank you.
Well, there you go. Another insider, this time from the Federal Reserve. It's always great to get around Danielle DiMartino Booth.
Yeah, absolutely. She's a brilliant gal, super high energy, wicked smart. And the one thing about her is she's really not a Fed hater, like abolish the Fed. She's more of a Fed reformer. But she definitely knows that there's some things there that aren't working properly, and the Fed could use some work. I mean, hence, her book, Fed Up. But again, there's paths forward. And I just keep coming back to that as we go through this, that even people that have been intimate with the beast, if you will, and seen the problems up close and personal are still feeling like there's hope out there and that there's ways forward. So, we have a lot of work to do as a nation, as a world, and of course, as individuals and organizations. But at the end of the day, there's a lot of reasons to believe that there is going to be a path forward that has prosperity in it. But we do have to recognize the system may not be exactly what it's been, as some of its flaws are being revealed and are going to need to be reformed.
So that really wraps up the 3 parts of the webinar series that included our view of the insiders, if you will. We heard from Nomi Prinz, we heard from Richard Duncan, and now Danielle DiMartino Booth. At the end, we will also have a panel discussion with all of our faculty for the webinar series, so you'll hear from the insiders there. Next, we're going to change gears a little bit, and we're going to talk to certified public accountant Tom Wheelwright. He's done a lot of research into what's happening today in terms of the new tax laws and the CARES Act and all of those things. So next up, CPA Tom Wheelwright.
Hey everyone, thanks for watching. Before you go, 3 things. Number 1, click the subscribe button, because when we have more subscribers, it makes it easier for us to attract better guests to share great content with you. Number 2 is click the notification bell to be sure that you're notified when we put up new content. This is obviously an ongoing situation. We're going to have continuous discussions about it. You're going to want to make sure that you're kept up to date. And then number 3 is make sure you share it. Tell a friend. Help us flatten the economic curve by getting more financial education out there to people who need it. Okay, so you know what to do. Click the subscribe button, click the notification bell, and we'll see you in the next video.
Systems break, and suddenly your family, friends, and neighbors are distracted with Wall Street stock indexes and Washington political pandering. Many are unaware and unprepared. Like COVID-19, ignorance of looming financial perils is also a disease, and the system is fragile. But you can help. Financial education is the vaccine. Share this free video series while there's still time. Alert people to these serious issues. If things turn quickly, the financial support system could be overwhelmed to the point of collapse. Help flatten the curve and reduce the impact on the financial system. Wake up more people to prepare. You have nothing to lose and a lot to gain. Share this video directly or invite people to visit crisisinvestingseries.com.